Hello, everybody. Ed Yardeni here. Thanks for joining me today. Hope you all had a good week. We had a bunch of our relatives over, my 5 kids and 2 grandkids and all the other assorted relatives. So we had a great time. It was almost like a 3-year anniversary of the COVID epidemic. Because most of us gathered together at my house here during the COVID epidemic. But it was nice to have everybody over. The only problem I have now is my 3-year-old grandchild kept asking Alexa, the Amazon artificial intelligence, to play Gummy Bear. And I've got that in my head. I just can't get it out of my head. But she enjoyed jumping up and down to that song. It is pretty catchy, actually. And then there's that shark song. I forget what that's all about. But anyways, weather's been kind of nice here, very sunny, but still on the cold side. Hope you're starting to get a sense that spring is coming, and we're getting a lot of rain, actually. So it's just like the song said, April showers bring May flowers. Well, what will April bring in May? We're supposed to go away in May. I never bought that idea for the stock market to go away in May, because you have to be a genius. You have to not only get out before May, which I guess you don't have to be a genius to do that. You just have to follow the adage. But where you've really got to be a genius is you got to pick the bottom. And I think the old adage about going away in May said something to the effect, go away in May and come back in October. The problem with that is there have been plenty of bottoms made before then and a few made after then. So that's always the trouble short-term investors have with the market, is you've got to not only pick the top and gloat about what a genius you were, but you also have to pick the bottom. Then you're really a genius if you can do that. Unfortunately, most bears have it sort of in their DNA. And so they're always calling a top in the market. And when it finally happens, they told us so. But they rarely get us in at the bottom. I have a pretty good track record of getting everybody into the bottom. I'm still working on getting everybody out at the top. So I've had a few good calls there, but a few misses as well. Anyways, where are we now? I think October 12th last year was low in the market. We've had a nice rally since then, back to the February 2nd highs that we saw earlier this year. And now everything's been kind of eerily quiet, not much volatility, just kind of going sideways in a very narrow range near that February 2nd top. And there just doesn't seem to be enough momentum to keep going and kind of break out to the upside. I think the market's kind of torn between what the Fed's doing and what the Treasury is doing. I think there's a growing consensus that whether the Fed does or does not do 25 basis point increase at the early May meeting of the FOMC, it's probably going to announce a pause. I would think that'd be a reasonable thing to do. The FOMC minutes that came out for the previous meeting show that the staff of the Fed is forecasting that there'll be a mild recession in the second half of the year. Maybe they're forecasting that the FOMC is just going to keep raising rates and that's what's going to do it. But it sounded like they were basically saying because of the banking crisis that's unfolded, that we're going to have a mild recession in the second half of the year. And yet that previous meeting was basically less than 2 weeks. Let me just shut this thing off. Okay. Now alone at last. I just got distracted here. So the FOMC minutes indicated that the Fed was done. What was that the FOMC staff was thinking about a recession in the second half of the year, and yet despite that, the FOMC voted a couple of weeks later to raise the Fed funds rate. Boy, oh boy. Sorry about that. I always take care of these things. Sometimes I forget though. I'm getting the hang of this. So the FOMC minutes indicated that there was a, this is the third time in a row I'm telling you this, that there was a recession in the second half of the year. And despite what the staff was saying, the FOMC said, well, that's nice, but we're going to raise the Fed funds rate by 25 basis points anyways, which seemed like a little bit, shall I say, insane, given that the banking crisis had just started a couple of weeks before, and it was not exactly clear whether the Fed's initial response was going to work. And as we know, one of the main reasons for the banking crisis is disintermediation. The Fed's been raising short-term interest rates so quickly in the money markets that more and more people are starting to get the idea that maybe they shouldn't keep their money parked at the banks and deposits and move them over into money market instruments. So it's putting a lot of pressure on the banks to raise their deposit rates, which then puts pressure on their profitability. And in any event, the shock of what happened with SVB and Signature Bank is probably going to have some impact on credit lending terms. And we know that they were tightening up even before the banking crisis. Yet the FOMC decided, what the heck, let's go for it. Let's show our determination, maintain our credibility in fighting inflation. That may continue to be their mentality going into this next meeting, and they might be 25 basis points. But I would think that in combination with the banking crisis and now with the beige book indicating that things are pretty slow and that inflation's moderating, I think they may do 25. I don't think that's wise. I think they should leave it as is, but they're likely to do 25. And then I think at the same time, they'll announce a pause. So the market, I think, is sort of seeing that, thinking about it, and that should be bullish for the stock market. On the other hand, we've got this debt ceiling X date coming, and now it looks like the X date's going to be coming sooner rather than later. That instead of late June or July, the Treasury is going to run out of cash by sometime in early June, and because of the debt ceiling limitation, they're not going to be able to issue more debt in order to keep the government funded. So that's where we are. I think the debt ceiling impasse will be resolved, as it always is. Maybe this time around, they'll play tough again on both sides and get awfully close to a default, or maybe there will be a default for a couple of days. I think in that case, the bond and stock markets would sell off pretty sharply and send a pretty quick, loud message to those folks in Washington that they've got to get their act together and get this thing done. And so I think it'll happen. Until then, I think the market may just kind of mosey along sideways. If in fact the Fed announces a pause, and if in fact we get a resolution of the debt impasse, then I think the market will have a nice summer rally that could get us closer to my year-end target of something like 4,600. Let's look at a couple of charts here that are relevant to our discussion here. So let me share my okay. So, well, actually, I did want to show you this chart. Let's see if it pulls up. Oh, yeah, one of our accounts just gave me a heads up and shared this research piece. It's called Proxy Funds Rate. It's from the Federal Reserve Bank of San Francisco. And there was an article a few months ago about it. I'm about to read it, and I'll write about it. But I thought this kind of is consistent with the view I've had, that you can't just look at the federal funds rate when you assess what monetary policy is doing. These days, there's so many other related policy moves that they're like, forward guidance has an impact on the economy and the financial conditions. The spreads between high yield and government securities is an indication of the extent to which monetary policy is tighter or looser than indicated by the federal funds rate. Same thing can be said for lots of other spreads, mortgage rates, versus the 10-year. Again, I haven't read the article, but I suspect that that's what they're doing, is they're putting a lot of variables in there to adjust the federal funds rate for whether other policy measures taken by the Fed are having are boosting the effective federal funds rate or keeping it down. So quantitative easing, as we can see here, clearly meant that the effective federal funds rate was below the actual. It was actually negative. And you might recall back in 2010, Bill Dudley, who was president of the Federal Reserve Bank in New York, and made exactly that argument. He said, our econometric model says that the Fed funds rate shouldn't be zero. It should be minus 75 basis points. And at that point, thank goodness, they weren't into going negative on the Fed funds rate. They never did do that, whereas the ECB and the BOJ did that. But they said that their econometric model showed that if, in fact, they bought $600 billion of securities in the markets, treasuries and mortgage-backed securities, that would be, in effect, comparable to a minus 75 basis point Fed funds rate. So you can see this is all consistent with this article about the effective Fed funds rate. I've been arguing that quantitative tightening is analogous to, or is comparable to, a 50 to 100 basis point increase in the Fed funds rate. And that's pretty much what I think this thing is showing. In addition, of course, the forward guidance has been a tightening measure. And now, so you can see that the Fed funds rate is effectively at more like 6% than it is like 5%. The latest data was the end of March. So that's something that I hope Fed officials are considering, and might influence their thinking. All they have to do is tell us that they've pretty much accomplished what they sought to accomplish, which is to get the federal funds rate up to a restrictive level. And I think it's that restrictive based on what we're seeing with the banking crisis. It has been contained so far, but I don't think you want to kind of risk that it won't be contained if they keep raising short-term interest rates. And in effect, they're already at 6%. So they can make that argument and maintain their credibility. They said it over and over again. They wanted to get restrictive, and then they said they're going to keep it there, which would be fine. I think the economy can handle it. Let's look at our charts for the morning briefing this morning. And did quite a bit of looking into the latest situation in the banking system. As you know, on Thursdays, there's a report that comes out called the H41 report from the Fed, and that's Thursday at 4:15, and that shows the assets and liabilities of the Fed. And then on Fridays at 4:15, there's another report called H8, which shows the assets and liabilities of the commercial banks. I never really paid much attention to these things until the banking crisis hit, and now they're very useful in assessing how it's going week by week. And so you can see that the Fed's securities quantitative tightening is continuing apace here. They are continuing to reduce the size of their balance sheet. On the other hand, the overall assets popped up a bit because of this increase in liquidity facilities. We measure liquidity facilities simply as total assets of the Fed minus the securities that they're holding, and that effectively is mostly accounted for by the liquidity facilities. This is just another picture of the securities holdings, and you can see that they're cutting back both their treasuries and mortgage-backed securities. Mortgage-backed securities are going more slowly than the treasuries. But again, when I get this report, when we all get this report on Thursday, there's data on there that's called primary credit, other credit extensions, and then there's this new bank term funding program. And you can see that this red line is still quite elevated at $173 billion, up from zero. And that's mostly funds that were provided to the FDIC in order to resolve the SVB and the Signature Bank situation. So that may take a while to get that money back and to get that liquidity back down. that liquidity facility back down. The primary credit is basically the discount window borrowing. And you can see that took a shot up and now it's come back down. And it's come back down because the banks said, instead of this very short-term lending facility, they prefer the one-year facility, which is what the Bank Term Funding Program has done. So well, all this really is showing is that things haven't really gotten worse. Everything kind of hit the fan back in March 10th, which is when SVB imploded. And over the weekend, it was taken over by the FDIC. And so that's what that's showing. Then we have the H8 on Fridays. And in one chart here, we've got deposits, and you can see deposits were already coming down. And I think a lot of that had to do with quantitative tightening. But now if you have a magnifying glass, you can see that they're coming down somewhat faster. Meanwhile, loans still kind of at all-time record high, but maybe the slope is starting to change. And I'm not telling you this isn't going to start turning down, but I don't think this is going to, I think it's more likely to go sideways than turn down. I don't think we got a credit crunch going on. I think the banks are still going to be lending. And then you can see that the banks, the borrowings by the banks have gone up. And a lot of that, again, is the two banks that have failed, but other banks may be taking advantage of this borrowing facility to offset whatever deposit losses they've had. I mean, nobody's been talking about a deposit run since what happened to SVB, but we'll see in a second whether deposits are still running. And then we've got securities. Now, nobody really can tell when you look at that green line, the extent to which they drop is maturing securities that aren't being reinvested. I suspect that's a lot of what it is, and that's offsetting some of the deposit outflows, is just letting these things roll off and then using these proceeds to make the loans. And then, of course, there's that borrowing. Okay, so without further ado, save you the suspense here. You might have read it and seen what I wrote, but we do now week-to-week changes in bank credit, securities, loans, deposits, and borrowings, just to put it all on one screen. And you can see that bank credit took a big dive here when the banking crisis first hit. Then it kind of picked up a little bit. Now it's back down a little bit. Nothing it just doesn't look like a crisis, but we don't want to see this thing continue to decline. And it would continue to decline if the banks decides that we really are going into a recession and lending terms really tighten a great deal more. And most importantly, if they can't get the funds either through deposits or through borrowings or through maturing securities. You can see that the securities continue to mature. It's one of the reasons that bank credit is down. Bank credit is basically securities and loans. This is what is key to watch, I think, with regards to a credit crunch. This certainly looked like credit crunch kind of outflows, declines in loans, but subsequently they're up a bit. So we'll be watching to see how this plays out over the rest of the year. Deposits are still declining. You can see that $76 billion came out just in the latest week here. So that is something to be concerned about. Again, nobody's calling it a run, so it's not psychologically feeding on itself. But the banking crisis kind of woke a lot of depositors up to the fact that they're getting ripped off with the kind of rates that they're getting at the banks, and why not move it into a money market fund? Well, and now the banks are coming back and raising their rates, and they've got to compete with Apple. Apple now is talking about over a 4% rate for parking money with Apple Bank, I guess, or whatever they call it. Borrowings, this was the big crunch here. Not much of a crunch going on there. So I'd say all in all, we're not out of the woods, but I think there's still a path out of this situation. And I think the Fed did contain the crisis with its bank lending facilities. Then what we did is we created a companion book to, we have something called the Commercial Bank Book, which looks at these kind of flows. But then we focus on commercial bank loans in another book we just created, chart book, which basically has these charts in them. So you can see C&I loans looks like they're starting to get a little toppy here. This is where the long and variable lags in monetary policy comes in. The Fed raises interest rates, immediately mortgages go down, auto loans start to get affected. The most interest rate sensitive parts of the economy get hit. But then at some point you start to get some stress on the banking system, and then it takes a while to see that in lending standards being tightened and loans actually turning down. So we may be at that point, but not enough, in my opinion, to result in a credit crunch and a recession, but enough to keep us in a kind of muddling along scenario for the overall economy, with a rolling recession, as I've been predicting. Commercial real estate has got everybody kind of worked up, concerned, and it is a concern. You can see that the banks have almost $3 trillion in commercial real estate loans. They're at all-time highs, and they're not going to keep going to all-time record highs. They're going to either flatten out or go down, possibly go down. Construction loans are part of that, are included in the commercial real estate loans. And so we're watching those, and they look like they're getting a little bit toppy. Then we've got the multifamily properties. So, all this data was sitting there in the H8 all this time, and nobody was paying much attention to it. But now at least we're paying a lot of attention to it. And you can see that there's even some signs that the multifamily, there's something strange going on here, probably some, I don't know, we're still looking into it, but it's unlikely that this is going to continue to go up and fund more multifamily properties, though the demand may still be there. And then there's non-residential properties, which have kind of been flattening out for a while here anyways. Then let's turn to residential real estate. It's not really that relevant to the mortgage market, because we know that most mortgages wind up being made by Fannie Mae and Freddie Mac. But it is interesting to note that even during the crisis, bank loans to the residential real estate market actually went up. I was kind of surprised by that. Maybe it's high quality loans. I don't know why that actually went up. They didn't even, when you look at the large banks, back in 2001, they went sideways. So sideways is certainly a potential here, but we already know that housing is in a recession. Let's look at consumer loans, all-time record high, no credit crunch there. Credit card loans, all-time record high, no credit crunch there. Automobile loans, there's credit tightening for sure. We know that, and it's already been kind of flattening out here for at least a year, maybe even 2 years. So that's a quick run through of the charts and the discussion of the effective federal funds rate, which I'll be writing about next time. I don't see any questions here at all. That's I hope I've been getting through. So does anybody want to just say that they're here? Oh, there we go. Okay, we're here. Thanks, Gus. Sounds like poltergeist. They're here. Okay, well, we can cut it here if there's no questions. I can't believe that I was thank you, Hans. All good. I'm getting a lot of all goods, and we're here. I'll wait a second for. Thank you. Let's see if there's any questions. Wait another minute. What would make, okay, Doug, what would make you change your view of a soft landing? Well, what would change my view is a hard landing, and I'd raise the flag and say I was wrong. I hope I don't stay to the bitter end with a soft landing, but clearly we'd have to see the labor market deteriorating considerably. Disney just laid off or fired another 4,000 workers. There's plenty of layoff announcements out there, and maybe they'll start to add up to a more serious problem in the labor market. But I've been arguing that people like myself, baby boomers, especially the ones that are retiring and aren't working for a living and instead are just enjoying retirement. I've noticed that a lot of my retired friends are constantly inviting us to go out to dinner or lunch with them. And then I've also noticed that the Ardennes are traveling more. We have a vacation planned for June and another one planned for, I think it's October. But don't worry, I'll have my laptop with me, and between myself and my staff, we'll keep on top of things. But that's led to a pretty significant structural demand almost for restaurant workers, accommodation workers, airline workers, and so on. So there's still a lot of demand there. And the people that are getting fired until the Disney folks, a lot of them were in the IT industry, and a lot of them probably got severance pay and got together with some of their friends and started another company. There's been a big increase in the number of company formations going on, but it would definitely take some weakness in the labor market to convince me that we're going to lose the consumer and get a hard landing. Because the consumer really is, 75% of the economy, and they've kept things going. The other thing, of course, would be that there's just, we haven't seen the end of the credit crisis, that it really does become a credit crunch, and that definitely causes a recession. But meanwhile, seems as though the stock market is in the soft landing camp, as is the bond market. Okay, let's see what else we got here. This is from Joel. Does the current federal funds facility act as similar quantitative easing? Oh, I see what you're saying. So in other words, is the bank, there's all the liquidity facilities. Yeah, I mean, and as I showed before, you can look at the total assets, and the total assets of the Fed have gone up, which suggests that they've more than offset their quantitative tightening on security side with basically the quantitative easing, providing liquidity to the banking system through primary credit and through these new credit facilities. So in effect, you could argue that, and I suppose you can therefore argue that for the effective federal funds rate, it takes some pressure off. Had to wet my whistle there. What is your current, this is from Nick, what is your current outlook for the strength of the dollar, the euro? I don't know, I tend to be dollar centric. For some reason, I tend to think that the US economy is got a lot going for it relative to other economies, very diversified rule of law, relative stability. We have our political tension and all that, but we have a fairly stable political and economic system, and so far the Fed's been fairly effective in at least avoiding a calamity. Maybe some of you think that this is all going to end badly, but so far it hasn't ended badly. And I tend to also believe that we shouldn't put all of our emphasis on what Fed and what the monetary and fiscal policies are doing. We should also focus on what we're doing, working for a living. There's a lot of people in this country that are working for a living, that are trying to do the best they can for their customers, for their families, for themselves. And we've got a very strong entrepreneurial class. Maybe for a while, the venture capital business is going to be hurting because of what happened with SVB, but I wouldn't underestimate the entrepreneurial juices of this country. We've seen recently that the big pharma companies want to improve their pipelines, and so they're starting to buy some of these biotech companies, and they've got the resources to make for more good products that are good for our health and not maybe our pocketbooks. So I think the dollar, I don't think the dollar is going to lose its status as a reserve currency. I'm not convinced that the axis of evil, Russia, China, North Korea, Venezuela, are going to come up with an alternative currency. I know gold has been strengthening, suggesting that some central bankers and foreigners, investors around the world, not just foreigners, believe that gold is the only way to secure your assets. I have no problems with that. I wouldn't put all your eggs into gold, just a little bit maybe. But I've never been a big fan of either gold or Bitcoin, simply because I'm an old-fashioned strategist and I need some income stream that I can discount. So I don't really see the dollar going down much at all. The dollar usually goes down when the rest of the world's doing at least as well, if not better, than the U.S. And I don't know if that's really the case even now. And as for the euro, the European stock markets have actually been pretty good. But the European economy, economic data has been on the mixed side. But I think to the extent that we live in a relatively unstable world, I think people are diversifying their currencies, not just putting it all on the dollar, but euro, yen, and that's the way I see it right now. Let's see if I got one more question here. I think we ran out of time already. Do you think ETFs are causing valuation disparities in the market? I've always thought that ETFs must be having some sort of effect like that because they are just buying baskets of stocks, and they're not being very discriminatory. They're not being discriminatory at all about what they own based on what they're promoting as their benchmark. I think it's been one of the reasons the mega cap 8 have outperformed is because they account for 20-25% of the S&P 500 market cap. And if people figure they want to be in the market and they want to do it with an ETF like the S&P 500, they are obviously putting more money into an index that's already significantly weighted towards a handful of stocks, and that tends to continue that valuation disparity, if you will. But it is what it is, and we have to live with it. One more quick question here. No, actually, we'll have to take it another time. We're running out of time. I hope you guys have a great week. I'm not sure about next Monday. I may have to do it Tuesday or Wednesday. I don't know. I doubt that you've noticed, but I've got a little retina issue, so I got to go in for a procedure for that. And then I'm not looking forward to 5 days of medieval torture. I actually have to keep my face down flat, both sleeping and during the day. So I've got these medieval furniture accessories that will allow me to do that. And I managed to lease them, and we'll see if I can keep my head down. So keep your heads down if things get wild. And I hope you all stay healthy. And if you have an issue, you just deal with it and move on. So all the best to all of you. Thank you. I'll let you know about next Monday.